So in a couple of my previous videos, I've talked about the tattooed chef disaster and how the company went from a $28 stock to now valuing under $2 a share. And with one of the largest YouTube creators promoting Tattooed Chef and The Honest Company, many are wondering whether or not The Honest Company is actually a buy. So in this video, I want to share my thoughts about the company's current valuation, what are the risks that I see, and whether or not I'm buying, selling, or holding. But I don't want to waste your time, so let's go ahead and dive right in. Honest is currently valued at just about $300 million. And with the company projected to do that much in revenues in 2022, it begs the question if this company is actually undervalued. But if we're honest, revenues should never be the main reason to buy a company. Over 2021, many investors bought companies based off of the potential revenue growth and pipeline. And unfortunately, many of these companies did not grow as expected. However, when we look at Honest, even though they almost fell back to their June lows this past week, their earnings weren't that bad. Looking at the revenues, they generated $85 million, which is a 2% revenue growth. Now this just beat analyst estimates, but it's pretty much in line. I personally expected them to do a little bit better, but their growth really isn't going to come from Q3 or Q4 of this year. It's going to really start in 2023, and I'll talk more about that guidance later. But I think it's important to look at the growth for the different categories. They split their revenues up into 3 segments: diapers and wipes, skin and personal care, and household and wellness. For their diapers and wipes, which is their largest segment at 65% of the total revenue, they grew only 3%. This really isn't big growth in comparison to 9% the quarter before, but they have continued to grow their consumption compared to the overall category growth by 3%. Now their wipes have continued to perform really well, as they have doubled the growth of the overall category. But all in all, I would say that the diaper and wipes numbers were okay. Skin and personal care, which makes up 26% of their Q3 revenues, had a decline of 13%. Now this was a concern for me because I do feel like over time this could be a larger segment for them. And the reason for the decline is not good. They said that the revenue was negatively impacted 25 percentage points because of our prior year skin and personal care rotational program. So this was a one-time program and hurt them significantly. I'm really thinking about how long it could take to make that 25 percentage points back up. There is certainly the risk that this segment could fall flat on its back. But if we think about it, you take out those 25 percentage points and they're actually growing 12%. Plus, even though this hurt them massively, this means that they won't have to face this one-time program next year. So it could be easier to beat revenue numbers. The last segment of their business is their household and wellness. And I don't think many people expected these kinds of numbers. They increased revenues 115% year over year to over $7 million. Now this does only represent 10% of the total revenue, but this could grow in the future, and here's why. Their growth for this category was driven by their baby clothing business, and this is something that they are planning to scale in their retail footprint for 2023. The baby clothing business is run rating about $15 million this year, but they are expecting significant growth over the next year. Now this used to be a royalty arrangement, but now it is part of their conventional supply arrangement, so they will get the full revenue and associated costs. So we will see how much this actually affects their overall business. But I think that it's also a risk that the company may not grow as much in the baby clothing as they are expecting. When we consider the growth of Honest in comparison to the overall category, they are still performing very well. And in an environment like this, where people could possibly begin moving to cheaper items, this is nice to see. For their diapers and wipes category, I already mentioned that Honest grew 6%, which is better than the 3% overall growth. When it comes to baby personal care, Honest grew 7% while the category declined 3%. And for beauty, Honest grew 15% while the overall category grew only 9%. So they have continued to outperform their competitors and continue to innovate with new products. With that said, I do recognize that there is also the risk of Honest not performing as well because consumers don't have as much money to spend next year. As a newer company in a sector that is already well established, they have to be able to outgrow their competition and take market share. So their growth in comparison to the overall categories will be something I'll pay close attention to next year. The next piece of the earnings that I wanted to look into was their gross margins, which decreased from 36% to 30.3%. Now I think many of us can figure out that inflation has not helped the cost of goods, so that will have an effect on their margins. But there were also increased prices for inbound freight, transportation, fulfillment, and warehouse expenses, plus increases in trade promotion spend. But they did benefit from price increases and cost savings, which I talked about in the previous earnings call, and that showed itself slightly this quarter as they did increase their margins 30 basis points over the past quarter. That being said, I really really don't think we will see major impacts in margins from these price increases until 2023. And this is a major difference between Tattooed Chef and Hnst. The Chef had a terrible time figuring out their negative gross margin situation, but for Hnst, they still have strong margins despite the inflation pressures. However, there's definitely the risk that inflation pressures continue, and this could reduce their margins more, which impact the pace to profitability. It's important to note that because their costs have exceeded expectations in Q2, they pushed back their positive EBITDA, or earnings before interest, taxes, depreciation, and amortization, to Q4 of this year. So they ended up having an adjusted EBITDA loss of $5.6 million. Personally, I'm more focused on them gaining market share, because when they have a brand that people will want, they will have pricing leverage leading to better margins. The Hnst company is the kind of brand that many people from this generation and the generations to come are going to be looking for. So there is great potential for this company in my opinion. I see them being more connected with the current and upcoming generation who are having children than the other larger companies, and that is why I believe that the Hnst company and the idea of clean lifestyle products could be trending for another decade, leading to greater gains in market share and significant improvements in their margins. For me, unless they push back their positive adjusted EBITDA expectation to a year from now, I'm not worried about it. In terms of where their product is being sent, here's what we got. They have started their launch into over 2,500 Walmart stores. They are in over 600 Ulta stores and 1,400 GNC stores. They are also expanding their partnership with Nordstrom with skin and cosmetics into Nordstrom Rack. Previously, the company announced that 42% of all new births happened in the Southeast, which was an area that Hnst did say they felt underrepresented. When you consider the fact that in Q4, the Hnst company will begin the in-store partnership with Walmart, where they will sell their largest segment of products with their diapers and wipes collection, this could be a major source of revenue over time. Let me put it this way. Walmart has a lot of stores in the Southeast, and for people that shop at the same store, in this case Walmart, many of them have never been exposed to the Hnst brand. So when you consider the fact that they are showing their presence in the most populated stores, especially when it comes to new families, there is no telling what this company could do for revenues in 2023. But at the same time, there's also a risk here. When we think about Walmart, customers may just want to get the cheapest items or simply get what they feel most comfortable with, which means the expected growth may not actually come to fruition. And this leads to the management team's guidance. They are expecting to be between 7 to 10% over the first half of the year. Now, this isn't much for guidance, but based on the kind of expansion they have into new stores, plus their baby clothing line, I wouldn't doubt them getting to double digits as they get to the end of 2023. But this is going to be dependent on what happens as they expand into Walmart and the other new stores. Onto the balance sheet, the company finished the quarter with $41 million in cash and cash equivalents and short-term investments with no debt, which is great in this economy. They also believe they don't anticipate their cash position being impacted despite the increased investment in working capital. Now, of course, take this with a grain of salt, because plenty of companies have said this and then they lose $100 million in a year, which is what we saw with Tattooed Chef. But I believe with the company valued at about $300 million, this is a healthy amount in my opinion. Another thing that is important to see is that they have about $39 million in accounts receivable, with almost $250 million in total assets and about $93 million in total liabilities. So balance sheet wise, I'm quite pleased. And there isn't anything really that I'm concerned about, especially because they have been able to maintain a pretty strong cash position throughout the year. One thing that I love about Hnst is that they are very clear and transparent with their numbers. It's not simply just what they reported for revenue, but where that revenue is coming from. Is it in diapers and wipes or personal care? Is it digital or is it retail? Even when you go to the Q&A section of their conference call, they are well prepared for the questions that are being asked. And it shows me that they are running the company well despite the headwinds that we have seen from this past year and the current economy. The last point that I want to make that I believe is really important is how the company is going to perform in 2023 and beyond. When I think about the fact that the company is going to have positive adjusted EBITDA, plus they are planning to increase prices in December, which will help even more with their margins, this could be a fantastic year for them on the margin side of the business. For their revenues, I wouldn't doubt seeing the company reach double-digit growth in the back half of the year, especially considering that they could be close to double digits in the first half of the year, when they're still trying to expand into new stores and continuing to innovate on every segment of their business. but I also understand that there is a risk they won't generate as much revenue as they are expecting. In my opinion, the company is extremely undervalued because of the possibility of achieving positive adjusted EBITDA in 2023 and maintaining a solid cash position over this past year. But because they are not profitable yet, this cannot be a top 3 position for me. I'm continuing to add, especially if the company remains in the $3 range. I see outstanding potential, and given the statistics I've mentioned previously, I think this one also has a small amount of risk for being an unprofitable company. Hope you all have a great rest of your week, and I'll see you in the next one.